Hey, good morning, everyone. Hello.
Morning.
Yeah, good morning. Good morning, everybody. I don't know who just responded to me, but if you, I see six people in the collaborate session now, but
Good morning, Professor.
hey, good morning, Jason. Good morning.
I
Yeah.
I'm sorry I kept on using new ones. I should have been using the same one. I still haven't received my book yet.
Okay, but what do you mean using new ones? Oh, you mean
Emails.
emails? Oh, yeah.
Yeah, that was me
No, just
emailing you
it's a matter of
the other day.
yeah. It's a matter of getting it's a matter of getting used to. But also another matter of getting used to is signing into today's discussion board. Okay, because before I came here, I quickly looked into today's forum. And I see now a couple of people. Yeah, good. Yeah. So I see six people in the collaborate, but more than seven people in the collaborate. But I see only four people in the discussion board. But please remember, I've been emphasizing this over and over that the discussion board is your sign-in sheet. It's your digital sign-in sheet. Okay. Okay. I'm trying to share my screen, but as I um, speaking and trying to share the screen at the same time, I just get distracted repeatedly. But since I'm sharing my screen now, you can see. So this was a while ago. Now let's see. If I have seven people here, that matches the number of people. Uh, it's only six, right? It says seven here, but that's including myself. So it's only six actually. But how many people do I have here? I have seven people,
You
right?
have
So
a note taker as well.
I don't. Yeah, I see. Jessica Martinez, I believe. Jessica, you're the note taker, right?
Yeah, I'm the note taker.
All righty, thank you.
She's
So
my
Yeah.
note
I have
taker.
yeah, huh?
She's my note taker.
Yeah. I know. Uh, I gave her the access. I extended the access to her, so of course I know. Yeah, so if I have six people on the in the discussion board, then that matches the number of people here. Of course, we have like 25 people on the roster, 24 or 25 people on the roster. So I'm expecting more people to join. So as you join, please, um, before you come to the collaboration session. So let me drop that instruction in here. So I want everyone to report attendance in today's forum. Okay. What must be done? It's the first order of business. Alrighty. So I hope everyone can see this, even as they join the class. So and please remember, it's your loss if you don't do that, because when there is no physical record of your attendance, then when I check attendance, I wouldn't know if you were in class or not. So you remember you earn 0.16 point for attendance, and at the end of the semester that will add up to 5 points. And you might wonder, that's not a big deal. You might think that's not a big deal, but it will be a big deal, because you will, because of marginally falling short, you will be, for example, by missing that 5 points, you will be below. I mean, if you had earned that 5 points, you could have been in, let's say B plus, but because of missing those 5 points, that means you haven't reported attendance at all throughout the entire semester. Then you will be in B minus, right? So it makes a big difference. And also the participation point, I give you 0.25 for average answer, and 0.5 for great answer, and 0.75, I believe, or even 1 point for great answer. So at least, if you give me an average answer, that racks up your participation point. So that will make a big difference at the end of the semester. It will make a big, big difference. So at least don't lose your attendance point by forgetting to sign into the discussion board. Now, okay, enough of that. So let's continue with, okay, I think I lost. I'll have to open that again then. I think I lost that. So let me open the let me open the file. Okay. All right. So in our last class, we couldn't achieve much because we were here talking about the interest rate, but then the discussion was rather about the inflation, and what was that about? You can go back to oh, this is not. We can go back to I don't know how many people review our Collateralized session after class, but there was there is that recording of September 13th session, and then I've been telling you over and over, the Collateralized session is not the main lecture. The main lecture has already been delivered by the pre-recorded lecture videos. Today's assigned videos are these two, because we have only 1 hour today. And these were videos that were available. They were excuse me. They were available for 5 days, and our last class was on the 13th. So they were available until the 18th, right? Until the 18th. And so because of the holiday schedule, there were the classes were far apart for the last couple of weeks, and so the ones that already lapsed, the ones that already expired, long before. I've been telling you, how do you watch the lectures that are already expired, long before? that had already expired. I've been telling you, you can find them on YouTube. Okay, you can find them on YouTube, and
I
so
had actually made a backup of all of them by downloading
oh
them.
oh, you can download. Can you download the YouTube videos, or maybe you cannot download YouTube videos, but my
Actually, you
lectures.
can if you have
Oh,
like the YouTube account.
oh, okay, good. I mean, if it is not YouTube and something went wrong, so I guess I will. Okay, I will have to come back to that later. Um, good. If you have downloaded it, good. Um, so the main lecture is, not the collaborate session, but uh, so let's get back to our. We're kind of a little behind because of the holiday schedules and the discussion about the inflation, last in our last class. So and the reason we are talking about the interest rate is because interest rate is the baseline. It's the bottom line of all return on investment, right? Because um, it's the lowest and risk-free return on your money. And when I say risk-free, right, think about it. First of all, there's no dispute that the interest rate is immaterial. I mean, it's the lowest return on the money because these days the interest rates are um, immaterial. It's almost derogatory. You don't get even 0.1% on your savings account. It would be like 0.01%. And um, but that's called borrowing rate. Borrowing. Uh, in other words, when you put your money, let's say you have $10,000 and you put your money in the bank and you have a savings account, put your $10,000 in the savings account, and what do you get? You don't even get, the whole year. You don't even get $10 uh, on your $10,000, right? So
You'll be
it's
lucky
almost
enough to get a penny.
uh, if you put $10,000, you'll probably get a penny, more than a penny at least. Uh, but that is called borrowing rate. Why? Why is it you are putting money in the bank, but why is it borrowing? Um, Actually, the bank is borrowing and you are lending. If you put your money in the bank, you are lending, but you never may have realized that you are lending. Of course, you don't intentionally lend, but you are lending passively. When you're saving with the bank, it's an act of lending, passive lending. Okay? And from the bank's perspective, it's called borrowing. It's borrowing, passive borrowing. They have to pay something on the savings. They have to pay something on the deposits. So they uh, they pay interest, which is not even 0.1% these days. I mean, 1% of 10,000 will be 100. Isn't that right? So 0.1% of 10,000 is $10. You probably don't get even $10, but that's what it is now. But in the old days, it wasn't like that all the time. Um, uh, we get only like 0.1, less than 0.1% on the savings uh, since 2008. Okay, because 2009, January 2009, the rate fell. The benchmark interest rate for all interest rates is Fed funds rate, and the Fed funds rate fell to zero. Zero is 0.25. Uh, so it was actually, Fed funds rate isn't fixed at 0.25. I mean, it's got a range. It is between 0 and 0.25. The effective rate is between 0 and 0.25. Okay, it moves within the range, and it's been like that since the financial crisis, right? Since the full-blown financial crisis, and by the beginning of 2016, it started to go back up, but then back to 0% again since the pandemic. Now, so why? I heard some there's noise ding, and that means somebody's typing in something in the chat box, but I can't see it, right? So if you have something to say to me, please speak, right? Please speak up, because this is what I'm looking at. This is what I can see. I don't have dual screen. I've always meant to get dual screen monitors, but then I haven't got a chance to get down to that. I have to also buy the connector or dongle or something, and also I have to first of all, I have to clean up my desk. I have too many things on my desk. I don't have room for two extra monitors. So while I'm still with just a single monitor, please understand that I can't see what's in the chat box if you type in something there. So as I said, the rates were not always like that. Even early 2000, July of 2006, between July 2006 and January 2008, look at the rate, where the Fed funds rate, where is it? Where is that Fed funds rate? It was at 5.25. Okay, and that means, and it's this graph isn't showing anything before 2006, but in the early 2000s, the rates were very low. I mean, but even if it was low, it was at least 1.25, or at least the Fed funds rate, or 1.25 or 1.5. So it was at least around this level, right? It was somewhere here. It was somewhere here like this, right? That was before 2006, and then low interest rate meant from the borrower's end, right? Think about it. If you're a saver or lender, if you're a saver, you're also a lender. As I said, passively lending, right? Low interest rate is not a good news. Isn't that right? If you're a saver, low interest rate is a bad news. But put yourself in the borrower's position. If you're a borrower, low interest rate is a very, very good news. Isn't that right? So low interest rate in early 2000s, if you're old enough to remember early 2000s, of course you wouldn't. Most of you were probably born around early 2000 or late 1990s. So you were just you were an infant. You don't remember, or you were just about 5 years old. You don't remember what the interest rates were like in those days, or whether there was a housing. But if you're old enough to remember, early 2000s, there was housing market boom, right? Why? Now, as I said, think about it. If the interest rates are low, it's a good time for borrowers to borrow. And so who borrowed? Of course, businesses borrow. Why? Businesses Businesses always need capital funds. If the economy is growing, businesses will want to expand their production capacity. Isn't that right? If the economy is good, if the economy is booming, they will always want to expand their production capacity because they don't want to miss out on the rising economy. And rising economy means, consumers will have more income to spend. You don't want to miss out on that. The demand will go up. You don't want to miss out on that. If your production capacity is limited, right, currently, you won't be able to capture that increase in demand. So what do you want to do? You want to expand, right, your production capacity, and that your output will grow. Your output will increase. With more output, you will be able to meet the increased demand, and you don't want to miss out on that opportunity, right? So businesses generally borrow, right, when the economy is booming, and if the interest rates are low, then businesses increase their borrowing. And that is the main reason, the main stimulator of the economy, right? Because if they borrow money and put it into a capacity expansion, that means they will have to hire a construction company to build new plant for them. And so construction company gets paid. They pay their workers. Workers spend money, right? And then and also they will have to put new production equipment in the new plant. So the companies that make production equipment will get a job, get orders, and so they make money. They get paid. They pay their workers, and then all workers spend money, and your company too, because the company is now bigger. And the company has more production capacity, you need to hire more workers, right? So there are more workers. These workers get paid. They spend money. And they all feed back into the economy, right? So there's a positive feedback loop, right? And the economy grows again because people spend money. The production capacity of the economy has expanded, right? And then the positive cycle will again push the economy's envelope, right? That's output capacity of the economy increasing, and also the income of the people in this economy, people who work in this economy, will increase, and then so that there's that positive cycle going on. But then as I said, in the early 2000s, the interest rates were low, but the economy was actually not expanding that much. I mean, the production capacity of the economy wasn't increasing that much. Production capacity was stuck, and companies weren't borrowing anymore because the spendings, the income of the average people in the economy wasn't growing that much. And why? You might wonder. I mean, wasn't the interest rate low, and wasn't it in the early 2000s? No, it wasn't that low. Like in 2000, it got low around end of 2001 and early 2002. And the reason was, there was a recession, a brief recession actually, in the early 2000s, 2000 and 2001. There was a brief recession, and because of the brief recession, the companies weren't expanding their production capacity that much. because recession during the recession, people don't spend money. They hunker down, so they didn't. Instead, so what happened was, to stimulate the borrowing, Federal Reserve lowered interest rates, and then old interest rates went down too. And what happened was, uh, instead of putting money in the because the companies weren't borrowing, and the banks needed to lend out money. And I've been telling you over and over, the business of banking is not in lending, in borrowing, but in lending. Banks make money by lending money, if you think about it. Isn't that right? So banks must lend money by taking deposit on your savings. They will have to pay interest, right? So they are not making money by taking deposit. They will have to use that money that you deposited, right? They will have to use that deposit to make money, and then they will have to lend. They will have to make that interest from somewhere. They will have to make that interest that they pay you for your deposit from somewhere. So what do? They lend. They will have to lend. And since businesses weren't borrowing eagerly in the early, like 2000, 2001, what they did was they expanded lending to the housing market, right? Now think about it. Borrowers, interest rates are low, then this is a good time to borrow. And housing market is a very good opportunity for banks to lend. Why? First of all, think about it. Um, if you buy a house, right? If you buy a house, let's say you are buying a $1 million house. $1 million house is, first of all, getting a loan for $1 million is not an easy thing. But in case of house, it's not a very difficult thing. Why? Because if you default, right, they can always foreclose that. They can always repossess that house, right? They can lend you at whatever interest rate, but overall interest rate, the benchmark interest rate is low, so the overall interest rate in the economy is low. Mortgage rate is also low, so home buyers can afford mortgage more easily now. So they buy the house. And usually when you get a loan, especially mortgage loan, you make a down payment. Let's say you make 10% down payment, and then that means 90% is the loan, 10% is your own money. So if you're buying a $1 million house, and if you make a 10% down payment, at least you have to put up $100,000, which must come out of your own pocket. And then the remaining $900,000 will be the loan from the bank. And the loan in the past had a high interest rate, but now the interest rate is very low, so you are more you can more easily afford the loan. So the housing market started to boom because of low interest rate. And again, the reason the banks were turning their eyes on the housing market was because, think about it, as I said, they can always repossess, they can always foreclose on the house, right, on the property if you default, right? That's called, so the house is already collateralized, right? So when they make the loan, the house is not yours. The title is with the lender. The title is with the bank until you pay off the loan. So they can, if you default, they can always, foreclose on your house and sell it off, and they can recover their principal, right? They can recover the entire $900,000 or even more, depending on the resale value of the house. But think about it. Until then, they collect, principal and interest by monthly payments until you default. So this was an attractive instrument to make a lending against, right, from the bank's perspective. So housing market boomed in the early 2000s, right? And then, but then, they got into the banking industry got into an all-out war to make because the banks are all in competition, and the more market share they have. Think about it. In all industries, the company that has the most market share is the dominant player, right? The dominant player has the most market share. Obviously, there's no there's no dispute about it. It's quite obvious. So they all wanted to become number one in the market. So that means they have to make more lending, because by making more loans, they are inching up, or they are what's the word? They are increasing their market share. Rack and pinion, ratchet. Ratchet. They are ratcheting up. They are ratcheting up their market share by making more loans. And so, because they are in competition, then what even became available was the subprime loans, right? You may have heard of the subprime mortgage crisis. What is the subprime mortgage? In the old days, they couldn't. The lending was very restrictive, because unless you have a good credit, and unless you have assets to big assets to put up as collateral, and unless you had a good income. So good credit score, good income, good wealth, right? About the wealth part, we can forget about it in case of house, because the house becomes a collateral already, right? They don't really care about that, and they are in a competition, all-out war with each other to maximize their market share. So they ignored all of that, even the credit score, right? You didn't have a constantly good income, right, coming from permanent, constantly permanent good job, but it didn't matter. And normally, you wouldn't lend to a person who doesn't even have a job. Isn't it right? If you're making even a personal loan, you're lending money to someone, you wouldn't be willing to lend to someone who doesn't even hold a job, or even if they have a job, it's nothing but a hustle, or gig, right? So that you don't have constant income, steady stream of income. Then that's a high risk. But the banks were taking even that high risk. Why? First of all, they could, the house was already, collateralized, right? It's already a collateral. And then two, they could, and for these high risk category customers, and this high category customers are called subprime category, right? Because they are not clearly not prime category, and they don't have a good credit score either. But they didn't care, because there was something called, they used adjustable rate mortgage. Adjustable rate. Adjustable rate is that means also, in other words, it's called floating rate or flexible rate. Now think about it. When you make a loan, when you borrow money, you want to fix the interest rate. You want to lock into an interest rate, the lowest interest rate possible, so that if your loan term is 30 years, for the 30 years you don't want that interest rate to change. Isn't that obvious, right? You don't want if the interest rates go up. Let's say when you borrowed money, right? The prevailing market rate was, let's say 4%, and you have a great, excellent credit score, so you could get the loan at the slightly below the going rate in the market. So you get, you borrowed at like 3% or 2.5%, and you would want that 2.5% rate to remain constant for the rest of the loan term, right? You would want it to last for 30 years, because you don't want the rate to go up to 10% just because the going rate in the market goes up to 12%. Do you understand? So you always, you get a fixed rate. You want to lock into a fixed rate, and that's usually the case. But during the early 2000s, they allowed flexible rate for whom? For the subprime people, right? So then what happened was, in the early 2000s, people who couldn't really qualify for home mortgage got loans, subprime loans. Then they bought houses, and early on, let's say because they were given adjustable rate, right, or flexible rate early on, because in the early 2000s the interest rate was very low, like 1.25. Benchmark rate was like that. So even if you had a bad credit score, you could get it for like 5%, 4.55% or whatever. So if you borrowed $1 million annually, the interest rate is only 5%. So let's say even if you had just hustle and gig, right? If your income was from just hustles and gigs, you could afford to pay 1% of 1 million is 1,000. I mean, 10,000. 1% of 1 million is 10,000. So let's not say you borrowed 1 million, but let's say you borrowed 500K, 500,000. 1% of that 500 is 5,000, right? 1% of 500K is 5K, right? So if you got it, if your rate was 5%, 5%, that's 25K a year. Somehow you could manage, and monthly, 25K divided by, let's say, 2,000 something, you could manage. But you see what happened here, in 2006, July 2006, rate went up. So between actually, July of 2005 and July of 2006, the benchmark rate went up by about 5%, right? Because the benchmark rate in around 2000, July of 2005 was about 1.25, or at best 2%, and then it went up drastically like that. Then what would happen to the people with subprime mortgage? They were all on flexible rate, right? So adjustable rate. So now since the benchmark rate went up, that rate their rate also went up. So now it is, if their interest rate was 5%, now it's like 10%. Now 10% of 500K is 50K a year, right? 50K, and monthly it would be like like $5,000 a month, right? Less than 5,000, of course, but then people with no permanent good paying jobs, of course they default. They only have hustle, and when the interest rate goes up this much, that means and after the interest rate goes up this much, then and the reason this interest rate went up this much was to prevent the economy from overheating, right? The Fed took, so actually at the time, the Fed chairman Ben Bernanke took a precaution, precautious action, but it was too preemptive. It was a preemptive action, but that was too drastic. And then normally when they raise interest rate, they only inch it up by like a quarter percentage point, a quarter. Every quarter they raise it by only about quarter percentage point, 0.25%. So over a year, it will be like 1% increase. So for interest rate to increase by 5%, it would be over consistent increase of 1% annually each year consecutively for 5 years. And normally they don't do that. I mean, the interest rate may go up by 1% or 2% over a year or two, but they don't continuously raise it for 5 years, right? But then during this time, what happened was it went up by 5% over a year. So that was a too drastic preemptive action. That was a clear mistake by Ben Bernanke at the time. But then Ben Bernanke didn't lose his job. He got reappointed. He actually got reappointed. He served 2 terms, and then after that, Janet Yellen. Ben Bernanke made a mistake. From an economist perspective, it's a clear mistake. But those are very high ups in the economic policy. Larry Summers, Hank Paulson, Henry Paulson, Ben Bernanke, Timothy Geithner, all these people were also academics as well as policymakers. They worked in the government and worked in the asset management. Henry Paulson was also the CEO of Goldman Sachs at the time, and then he went to the government, as Treasury Secretary or economic advisor to George Bush, or but they are high and mighty. They have so much credentials as academics, as well as credentials as practitioners, as well as credentials for but then Ben Bernanke was this was clearly a mistake by Ben Bernanke, but none of them actually got took the responsibility for bringing about the financial crisis and the financial. It's a long story, so I'm not going to get to that this time. But think about it. These things, high interest rate would make the subprime borrowers, default. So massive default happened, and then massive, foreclosures happened, and the properties that were repossessed, what should happen with that? They should put it, the banks will have to sell them. But if it is just one or two, repossessed homes, they can resell it at the right value, right? At the right value of the house. But then, there was a massive supply of that because of massive default and massive foreclosures. So when there's like an oversupply, right? It's excess supply, and not just excess supply, huge, excessive, massive supply of, repossessed homes to be sold in the market. What would happen? The price will have to, there isn't that much demand. There isn't as much demand as excess supply, but there was huge excess supply. What's going to have to happen? The price of the homes will have to drop drastically. Okay. Okay. Is there any questions so far? We are almost out of time, so let me quickly get back to. So that is the reason for housing market collapse, and the housing market was actually, housing market, all those, and the banks could only recover. Think about it. Banks could only recover not even half the loan amounts, because the houses had to be sold to recover the loans, but the loans, the house values have drastically dropped, so they couldn't even recover, not even half the original loan value. So then what happens? Those who guaranteed all those loans, successively, collapsed, and that brought down the entire financial market. So that was, the reason for the financial crisis of 2008. And then what I wanted to say here is the banks, when they take a deposit and they have to pay you interest. That's called, a borrowing rate. It's called borrowing rate because it's from the industry's perspective. From the bank's perspective, they are borrowing, so it's called borrowing rate. But when they lend to you, when you borrow money from the bank, it's called lending rate because the banks are lending to you, and it's called from the bank's perspective because they are the industry. From the industry perspective, when they are lending, it's called lending rate. For you, it is borrowing actually. And when they lend and when you borrow, the interest rates are not the same, right? When you put your money in the bank, you all get, regardless of your credit score or whatever, who you are, whether you have good income or bad income or whatever, good credit score, bad credit score, it doesn't matter. You only get 0.1%. But when you borrow money from the bank, then your interest rates are all different. It depends on your wealth. It depends on your income. It depends on your credit score. So if your credit score is excellent, if you have good income, if you have sizable wealth, all of that will make you qualify you as a low risk. And if you're low risk, because you will have low risk of defaulting, if you have low risk, then your rate will be very low. Because you're low risk, they don't have to charge high interest. And if they charge high interest rate, you can always take your business to somewhere else, right? So they don't want to lose your business. So the banks cannot, the rates will be competitive. One bank cannot charge high rate on you when you have a very good credit score. Okay, when you are excellent prime borrower. Okay, so the lending rates vary. If you have bad credit score, if you have low income, no sizable asset, you're a high risk. So your lending rate will be higher. You're not lending; they are lending. From your perspective, you're borrowing, but it's called, lending rate from the bank's perspective. Okay, so we'll have to come back to this on Wednesday. Any questions so far? Any questions? Okay, I see a lot of people here. I see 15 people. Good, and I hope Kenny, Fed will Fed will probably increase rates going into, yeah, because they will have to taper their they will have to taper off their quantitative easing uh, at some point, and it will be like at least as early as the end of this year, or at least to as late as 2023, but by sometime around 2022, I guess they will start tapering. All righty, so that's it for today. I will see you guys all. Have a good day. I will see you guys all on Wednesday. Okay. All righty. Take care, everyone.
Goodbye,
Stop.
Professor.
Okay, take care now.
Professor.
All right, take care. I will stop sharing and stop recording and signing out.